In the future, every industrial company will run two factories. One factory builds the machines, while the other builds the brains, the AI that powers those machines. And at the heart of this factory, one company shows up again and again, NVIDIA. Today, we are going to break down how NVIDIA became the central supplier of the AI revolution. We will look at why it is positioned to benefit from the $4 trillion AI build-out. And most importantly, what this means for investors. Let's get started. Let's start with the concept of the AI factory. Think of it like this. In the 20th century, factories produced steel, cars, and electronics. In the 21st century, factories are producing intelligence. And these AI factories don't look like assembly lines at all. They look like huge data centers packed with servers and GPUs. A 1 gigawatt data center costs about $50 billion all in. Out of that, roughly $30 to $35 billion goes directly into computing. That is where NVIDIA dominates. NVIDIA has over 80% market share for GPUs, which are used in AI model training. Every AI model, every generative system, every robot that needs a brain. It all starts in an AI factory, most probably powered by NVIDIA chips. These made up 88% of NVIDIA's revenue in 2025. And that segment has been compounding at 108% CAGR over the last 5 years. Now, here is where it gets really interesting. Jensen Huang projects that by 2030, the world will have invested $3 to $4 trillion into AI factory infrastructure. To put that in perspective, global wireless infrastructure over 20 years cost only a fraction of that. Cloud computing, another transformational wave, took over a decade to hit $1 trillion. AI is moving at a speed we haven't seen before. And to reach that 3 to 4 trillion, AI infrastructure spending would need to grow at around 40 to 45% compound annual growth rate. For comparison, the early days of mobile internet adoption ran closer to around 20–25%. AI is nearly doubling that pace. This isn't just about chips. Think about the scale of the AI ecosystem. Start with power and energy. AI data centers will consume massive amounts of electricity. That means major investments and huge upgrades to the power grid. Next, consider cooling systems. These massive data centers need advanced cooling just so that they can keep the GPUs from overheating. Then there is networking gear. Moving data at speed requires fast connections built specifically for AI workloads. And finally, real estate. Land and construction for these mega-scale data centers are becoming investment categories of their own. And sitting right in the middle of it all is NVIDIA, owning the single biggest piece of the puzzle, the computing layer. So, who is actually footing the bill for this massive build-out? It is the hyperscalers like Microsoft, Amazon, Google, Meta, Apple, and now xAI. These companies are locked in an arms race to dominate the future of AI. And unlike most industries, they have the money to spend at levels never seen before. Here is an example. Nebius is an AO neocloud which is backed by NVIDIA. It has signed a deal with Microsoft to lease its GPU infrastructure to support Microsoft's AI operations. The contract is worth about $17.4 billion over the next 5 years. But this is just the base deal. Microsoft may add more services that could bring the total closer to $20 billion. This deal highlights how third-party infrastructure providers are becoming really critical players in the AI supply chain. But here's what makes this cycle different. Governments are essentially subsidizing it. The Big Beautiful Bill, for example, allows full expensing of capital equipment, making it easier to build these huge data centers. Interest expense can be also deducted, which makes financing easier. On top of that, R&D can be expensed up front. Together, those three provisions are expected to free up about $50 billion in cash flow for the hyperscalers. And when companies like Microsoft and Amazon get extra liquidity, they don't just sit on it. They reinvest it into growth. That is why investors should think of this as a supercycle, not just a trend. Similar to the wireless industry, which saw 20 years of tower build-outs, AI infrastructure is just getting started. Cloud computing also experienced over 10 years of sustained spending. AI infrastructure is set to compound for the next couple of years, if not for the next decade. And unlike those past cycles, just the sheer scale of AI, with trillion-dollar projections, make it a generational investment story. Now, why NVIDIA? There are plenty of chip companies out there. AMD, Intel, and a wave of new startups like Arista are all trying to compete. But NVIDIA has a moat that is hard to replicate. First, its hardware leads the market in raw performance. But more importantly, its CUDA ecosystem has become the de facto operating system for AI computing. Thousands of developers and enterprises are already building on CUDA's platform. That creates switching costs and network effects. It is not just about having the fastest chip. It is about having the software and developer tools that make those chips useful. And NVIDIA isn't stopping at chips. It is expanding into the full stack, from GPUs in the cloud to enterprise AI systems to robotics platforms. And here is where it gets even more compelling for investors. AI native companies, the OpenAIs, the Perplexities, the Geminis, the Groks, are all scaling fast. Jensen Huang estimates that AI native revenue was around $20 billion in 2025, which is up from just $2 billion a year before. That is a 10x increase in 1 year. And where do these AI native companies get their computing power from? Almost all of it runs on NVIDIA-powered data centers. This demand is showing up directly in NVIDIA's results. Revenue in 2022 was $26.9 billion. In 2023, it barely moved. Then came the AI inflection point. Revenue jumped to $60.9 billion in 2024. And in fiscal 2025, it more than doubled again, hitting $130.5 billion. And analysts expect fiscal 2026 to see another 50% or so increase on top of that. Of course, no investment story is without risk. Competition is growing. AMD has strong chips in the pipeline, while Intel is trying to reinvent itself. And hyperscalers are designing custom chips to reduce their dependence on NVIDIA. There is also the risk of regulation. Governments are paying close attention to the AI boom, and additional restrictions on exports could limit NVIDIA's addressable market. But here's the counterpoint. Even if competition heats up, the pie is growing so fast that multiple winners can coexist. When the market is growing at 40–45% annually, you don't need 100% dominance to succeed. So, what does this mean for investors? NVIDIA isn't just a chip company. It is the backbone of the AI factory build-out. From cloud infrastructure to enterprise AI to robotics, it has positioned itself across the entire stack. The AI Capex wave is just beginning, and NVIDIA is set to capture a massive share of that spend. Thanks for watching, and please give it a like, subscribe, and watch another video. See you in the next one. Thank you. Bye.